Can I get my
Oh, absolutely.
my jacket there? No, you don't have to move anything. I just need to grab this and you can put it right back.
I don't know how long it would take to have that process. I wanted to see it for taking over like 6 years. So debating whether to just retake the classes. But I can start it from if you wouldn't mind.
From my understanding, of what they do, it would only be it'll be posted on your transcripts. Yeah, that has been like. That has been. Because it's in a policy, posted on like all. Yeah, since it wasn't being yeah. This happened, stuff like. I go to your program now and then. Yeah, that's why. And see
But they wouldn't send like half of the accounts I tried to get them. Like you couldn't figure out what it was. And it's much. So they were so, yeah, like when I got this, but I couldn't figure out what happened. Yeah, it wasn't making it was like, so there, it's like unrealized OCI. Loss. I'm not. But I only got to like, we got to like 7.
All right, let's get rolling. So I'll start with attendance. I'm going to try and speed that up a little bit. Bowen. No. Charles. No. Chisholm. Christian. Contreras. Curl. Peter. Tom. Hand. Lee. Linders. I did. There he is. McClure. Navarro. Present. Quintero. Ramos. Rodriguez. And Rodriguez. I have two of them, and I saw two hands. Okay, I saw two hands. Silvestre. Simpson. Von Henkel, Walker, and Wilson. All right. I think for the first time, I've got the recording working, because I know that you've got nothing better to do than stream this class. Where we left off last time was kind of talking about the stories. But before I dive into this, does anybody have any questions yet on the assignment or the quizzes? Anybody getting stuck on anything? Okay.
I have a second.
Sure. Lay it on.
So for what Google was showing, it already has us on chapter 3. We're following the syllabus, not Moodle.
Following the syllabus, not Moodle. So what I've done in Moodle is, and I'm going to start posting up the Moodle this week. What you see there is recordings for not only syllabus, essentially from the class that was taught last year, which was an 8-week accelerated. And so what you've got, oh yeah, if you can only imagine, 3-hour classes. So what you've got there is essentially all the recordings from last year's classes, with the exception of maybe 1 or 2 that where I have technical difficulties. So you can kind of, those will correlate with what's in Moodle. I'm going to clean up that piece and get those moved up to essentially either the first week or the last week, so that they don't get confusing. And for the first time, I think today, we'll cross fingers, I've got the recording working for Google Hangouts that'll then record this class, and you'll start seeing these classes get dropped in the proper spots as Moodle breaks down the weeks. The other question that someone asked was 2 times, can you see that I took the quiz 22 times? And the answer is yes, but it doesn't matter. So don't worry about, it records essentially each of the grades, and it records each time you took it. What it does for me is also shows, as you all take the quizzes, it tells me what questions folks are getting wrong and gives me the analytics around that. So that way you may come in and go, I don't have any questions, but I can take a look at the data behind the quizzes that you're taking and go, this concept doesn't seem to resonate real well, so it may take a little bit of time. So, but every time you take the quiz, yes, it records the grade. Yes, it shows that you took it, but for the purposes of the grade in the course, the highest grade counts. So don't be afraid to take it multiple times. Any other questions on topic or off topic or any topic? All right. So last time we left off with a balance sheet, and we kind of spun a story around the balance sheet and what we saw on the balance sheet. Today we're going to move to the income statement. As we talked about, the income statement, where the balance sheet says as of December 31st, this is the balances of cash, accounts receivable, this is our payables, this is what we owe. The income statement is designed to measure the changes in the balance sheet between 2 points in time. And so I know I've got a lot of accountants in the room. When you think about income statements, remember that's looking at it over time. Balance sheets are points in time. And the income statement essentially measures changes in the balance sheet. Why did the balance sheet change? Why did what we have and what we owe change between this date and this date? So the schoolhouse says, it summarizes revenues generated and expenses incurred during a particular accounting period, such as a fiscal year. We will tend to look at, in this course and in the real world, you will tend to see monthly, quarterly, and annual financial statements. You tend not to see, you can have income statements that are daily, weekly, not common. You can have kind of off-cycle income statements, and we're going to have some math in here where we're going to calculate things like 6 months and 2 months and 3 months for interest rates and such. But for normal purposes, you're going to see them either monthly, quarterly, or annually. And so that's what an income statement is. And this is what one looks like. And again, we're going to stick with Unilite. And we common sized the income statement. We kind of talked through some of this last time, and we said, okay, what do we see here year over year? If you recall, we said, okay, they're making a little bit more money, but they bought some new equipment, so the depreciation is up. The fixed costs have stayed the same or gone up a little bit because they've got equipment. And we talked about common sizing, essentially reducing everything to percentages so that it's easier to compare year over year, particularly if companies are growing rapidly or you have two companies of dissimilar size. It makes it easier to look at. So that's that percent of total sales. Those are some of the ratios. Any questions on the income statement stuff before we kind of keep moving? Okay. Statement of cash flows. The statement of cash flows for us, and we hit on this a little bit last class, is really important for finance. Where balance sheets and income statements tend to have accruals and non-cash items in there, finance is really concerned about cash flow, not about accounting profit, except to the extent accounting profit impacts cash flow in the form of taxes. And so we're focused, the income statement is going to provide you some information, but you really need to use the income statement in conjunction with the statement of cash flows in order to be able to start pulling out the information you need to really see how the company is doing. If you recall back to Monday's class, remember cash dropped significantly from year to year. The stock price went down, even though dividends are up, even though profits are up. So there's a question, okay, what's going on here? Why is the stock price down? Why did cash fall when it looks like they made more money? And we did some analysis just at the balance sheet, looking at growth in inventory, growth in growth in receivables, growth in payables. And so you'll see at the bottom, in my opinion, I'll try and preface things when they are in my opinion as opposed to in the book's opinion. In my opinion, this is the most underutilized and most important component of financial statements, and most people don't understand it and they skip over it and focus on the income statement. Here's some simple rules to remember on cash flows. When liabilities go up, cash goes up. Think of it this way, you're borrowing money. You owe money to somebody, so you got something, you're borrowing money, that's a liability. Equity account, when they go up, cash goes up because someone's invested essentially in the firm, and so they gave you money, so the equity goes up, cash goes up. Assets, when asset accounts go down, normally cash goes up because that means I had a car, a truck, a piece of equipment, I sold it, so my asset went down, I converted it to cash. Uses of cash, obviously, are just the opposites. Dividends, pay down loans, purchase equipment. So when assets go up, cash goes down. Sometimes it gets a little confusing, particularly when you're talking about things like payables and receivables and, why are receivables up and cash is down? Try and get a handle on the importance of the cash flow statement. And here's some sources and uses for Unilite. So we talked about the balance sheet piece, where we said, okay, we're seeing cash, accounts receivable went up, so cash went down by 25 million. Accounts receivable went up, so you can see that that's a use of cash. Inventory went up, that's a use of cash because it's an asset increasing. Plant and equipment went up, so it's a use of cash. Accounts payable went up, so that's a source of cash. Accruals went up. Accruals are accrued expenses. You can have accrued and deferred revenue too. Accruals went up, that's a use of cash. Notes payable went up, source of cash, long-term bonds. So they issued bonds. They borrowed money, that went up. Common stock didn't change. So the balance sheet piece says we got an additional, or we used an additional 100 million. We got 70, we used 170. Then you've got the income statement side. You had net income of 54 million. Depreciation. Why is depreciation a source of cash? Yeah, kind of. So net income here basically says, I'm treating, for the purposes of this to start, I'm going to treat all my net income as cash. But really, it's not all cash. We got to kind of unscrew that. Depreciation is a non-cash expense, right? So you go buy that equipment. We accounted for the purchase of the equipment on the balance sheet effect. We said, okay, we bought a bunch of stuff. That was a use. For accounting purposes, you take that purchase, let's say it's $100 million of equipment, you're going to depreciate it over 10 years, you take $10 million a year of expense. And so that $10 million of expense, you put out the $100 million in the first year, that's cash flow out. The $10 million in expenses flowing through your income statement, you're not writing a check for $10 million each year. So it's kind of an expense that isn't an expense. So you can see that that's sitting here as a depreciation. The increase in accounts, so that 50 million comes through as cash flow off the net income. You've got increase in accounts payable, which we just talked about, the increase in accruals. You've got subtractions for the increase in accounts receivable and the increase in inventory. So your net cash flow from operations, essentially the operations of the business, the turn the crank, this is what's happening every day. The business generated 34 million in cash. You bought $80 million worth of stuff. Then you borrowed to pay for all this, you borrowed some money. So essentially, when you look at your financing activities, that's long-term, that's how you long-term finance on the balance sheet. So you can see that what they did was they borrowed short-term, borrowed long-term, and they issued dividends. As a matter of fact, they issued 29 million in dividends. They essentially paid out, if you look at it in a little different way, and this is, we're looking at it more from a financial analysis perspective, not an accounting perspective. The entire operation generated 34 million in cash. They paid out 29 million of that to the shareholders. They borrowed $50 million, and they bought $80 million worth of stuff. They burned through cash. So what you see down at the bottom is there was a net change in cash of minus 25 million. Cash at the beginning of the year was 40 million. Cash at the end of the year was 15 million. Give me a couple stories on this. I heard they spent too much cash. What other things can you see here? I gave you one, which is almost every dollar that came in from operations was paid out to shareholders in the form of dividends. Only 5 million essentially was reinvested in the operations of the firm. 5 million of the profit. What else of the cash profit? What else do you guys see here?
Looks like they're trying to get shareholders really happy by giving out dividends. Maybe going on, like they're restructuring or something. But also much to make a profit and they're trying to improve their shareholders making a profit.
So if we look at, and that's a good story, because if we go back, and I know I skipped over it pretty quickly, but if you look at the dividends per common share, what happened between 2015 and 2016? Dividends went up. So they said, even though cash is going down, they said, we're going to pay out more. And we're going to reinvest in a bunch of stuff. $80 million worth. Earnings per share went down, dividends went up. So that's an entirely plausible reason. Companies tend to never want to cut a dividend. That's an alarm bell. Oh my God, they're cutting the dividend. That means they're not doing well. For a non-sophisticated investor, they go, that's bad. What we're going to learn in this class is that may be bad, that may be good. They may have better opportunities to reinvest that money and make you more money. Investors, and you can Google it, and when you look at investments, they'll go, here are the 35 stocks that increase their dividend every year. And some investors, that's what they want. I want dividends, and I want them to go up every year because that's a sign the company's doing well. Is the company doing well? The company's starting to not do well at all, but the dividend is increasing. They're signaling, the management is signaling to the investors, hold on. The company's doing fine. It's doing so fine, as a matter of fact, that we're going to increase the dividend. When you start peeling back the onion on this company, though, you realize that it's not doing all that well at all. And its performance is beginning to degrade. They're building inventory. They're not selling stuff. We talked through a lot of that story last class. Yes, sir.
I don't know how significant an 8% increases for like an unsophisticated investor, but with them doing that as opposed to just appeasing the shareholders, would that they be trying to like attract some new unsophisticated investors?
Potentially. And if it's publicly traded stock, like this example is, that's reflected in the stock price. You're essentially doing this to go, if you're going to attract a new investor, they're going to buy the stock likely on the open market, because what we see is 25 million shares were outstanding in each 2015, 2016. And so likely they're doing it to try and bolster the stock price. And 8 cents doesn't sound like a lot, but it's about a 7% increase in the dividend. It's actually, on a percentage basis, it's meaningful. But it is likely to signal to the market or signal to the shareholders that, yes, we're doing well, therefore buy our stock and keep the stock price up. Why might, when we talked through in the first week, why might management want the stock price up? Why do they care? Yes, sir.
I guess it shows like how people value or how valuable the company is.
That's true, but I'm looking for a more cynical answer. Yes, ma'am.
Wouldn't then you would be able to sell your shares for more?
Who?
The company.
The shareholders of the company could float the shares for more. Why else would management want to keep the stock price up? It'll make them look good in their bonuses, their stock options. It makes them look good to the shareholders, the current shareholders, who are less likely to then do something. And we walk through some of those choices that they could have. They can fire the board, they can sell the company, they can do those kind of things. So there's an alignment. In theory, there's an alignment normally designed in the compensation structure to have shareholder value maximized through the highest possible stock price, or stock price plus dividend, because you'll see how dividends play into stock prices in another week or so. So what you've got is, if they think the stock price is going to go down, they've got every incentive through stock options, bonuses, as well as they should be in alignment to keep the stock price up. So they're going to do things that may be window dressing, or that may be somebody's dividend policy, which again, we'll talk at the end of the class or the end of the course, to try and boost stock price. And we'll actually mathematically be able to see how this worked. Statement of retained earnings is the changes in retained earnings year over year. This one's pretty simple because there wasn't a bunch of stuff floated out. So you had retained earnings of 260 million, the net income of 54. They paid out dividends of 29, so retained earnings are 285. What are retained earnings?
Company doesn't get back to the shareholders.
Perfect answer. It's money the company reinvested and didn't give back over time. Now, again, when we looked at the statement of cash flows, we saw that from operations, really they only reinvested about $5 million. But because that income is an accounting measure, not a finance measure, the retained earnings actually went up by $25 million. Balance sheet, there's two sections of the balance sheet in my mind. There's the assets, what we have, and then the other side of the balance sheet, which is liabilities plus owner's equity, is how do we pay for what we have? And if you think about it that way in context of this class, it'll make understanding the balance sheet and kind of how we look at finance a little bit easier to understand. What do we have and how did we pay for it? Now we're going to get into some ratio analysis. Ratios are designed to, just like the common sizing, and we talked about the percentages common sizing last class, they're designed to make it easier for you to analyze certain financial statement metrics, both within a company and longitudinally, so over time, as well as between companies. the closer you can get to common size or a common language to be able to compare companies, to be able to do the analysis, and the more quantitative you can make it, the easier it is to get that baseline of data. So ratios are used extensively by finance professionals to reduce a volume of company information down to a couple things where there's some KPIs, key performance indicators, or where there's some benchmarks that they're able to go, okay, this is good, this is bad. And we're going to talk through a couple of those and a little bit of analysis today. The primary purpose for conducting ratio analysis is to provide you an indication of the future financial health of the firm. Remember, finance isn't worried about what's happened. It's worried about what's going to happen. We're trying to predict the future as it pertains to this company, and then based upon the future, look at what the value is, or the value of a stock, or the value of a bond. We're worried about the future. What's happened in the past is only valuable to the extent it informs us about what we think is going to happen in the future. So it does tell you how the company's doing now, but more importantly, it tells you about how you think the company is going to do in the future. That's what we use finance, or that's basic underlying principle of finances. We're looking at the future and we're going, how much cash is going to be generated in the future and how much would I pay for that today? There's 5 basic categories of ratios. Each one of these 5, once you put them all together, it's going to create kind of a collage or a picture of how a company is doing. Some of the ratios are really complex. Some are really easy. We're going to walk through a number of the most critical ones in class. You're going to get exposed to all of them in the book. You've got liquidity ratios, which is really taking a look at cash versus obligations and going, can we pay our obligations or not? You've got asset management. Why do you think asset management is important? Give me some rationale why asset management might be important to you if you're an investor or you're looking at a firm.
If they're investing in the money versus paying out the money.
Perfect. Perfect. So we took a look at Unilite. And Unilite retained, they paid out $29 million, and they retained the rest. You want to make sure that if they're retaining the rest, you're the shareholder, that's your money. This is your company, that's your money. You want to make sure that they're getting a good return on those assets that they are buying or the assets that they're holding of yours. Otherwise, you'd rather have them liquidate, pay it out to you in cash, and have you reinvest it somewhere else. So asset management is important because in the case of Unilite, for instance, there could be $300, $500 billion in assets. There's a book value, which is essentially the assets minus liabilities. That comes out to you if they liquidate. And so you're going, okay, I want to make sure that they're doing this well. Some companies do an extraordinary job on generating income over assets. Some do a terrible job. Debt management. Does the firm have the right mix of debt and equity? Can the firm handle more debt? Why do you think the debt to equity piece is important? Yes, sir.
Because you have to pay that back.
You got to pay it back. So if you start thinking about how all these interact, you might buy assets and you're going to fund some of it with debt and some of it with equity. You got to make sure that these assets return enough in cash flow to pay the debt back. The other thing that debt does, and we're going to learn about this in exquisite detail, is debt is good at the right level in the firm. I'm not going to say it's good for an individual because we're not necessarily firms, although the principles would hold. But I will say in a firm, debt, a certain amount of debt is a good thing. Why might that be? Yes, sir.
Does that go for all businesses or just larger businesses? Is that also true for smaller businesses?
In theory, it's all businesses. And in theory, depending on the risk, would determine what that ratio should be. And we're going to dive into that. Yes, sir.
That is good because if you need to buy something that's more expensive than just regular toiletries, if if you need a big purchase, you want to hold onto your cash on hand to be able to make better use of it than giving up 90% of it to buy your machine and stay relevant.
Valid. Yes, sir.
Essentially, you're using somebody else's money to make money.
Right. And so how do you think, and you had a comment too. Yes, sir.
Well, you have that means like you're trying to get stuff because you don't have it and you don't have enough money, so you think the amount that you borrow plus yours, you're gonna get back with what you want now. So you're like, gonna be using more assets by buying more stuff.
Correct. Now, we're gonna get into heavy duty finance. Think about debt. How much, let's use an interest rate of 8% on debt, which is high right now. That's a high interest rate, 8%. How much do you think you need to generate? So if you go, I'm gonna borrow money, 8%. And I'm gonna use it to buy assets, right? How much do you need to generate on those assets to break even? Well, let's say you do generate 20% on the assets. How much do you have to pay back for the debt, simplistically? 8%. Where does the other 12% go? Taxes will get some of it. Taxes will get a portion, but where does it go? It goes to the shareholders. So you borrow money because you go, I could borrow this money cheaper, then I'm going to reinvest it in assets or other materials, and a profit between the spread between what I'm paying for that debt, 8%, and what I'm going to earn on the assets I buy on that debt, 20%, is profit to me, the shareholder, 12%. It's free money. That's why debt is, in theory, good. The issue is, can you get that return, and what's the risk on the return up here? And we'll analyze that. Profitability. How do combined effects of liquidity, asset, and debt management affect profits? Companies, any organization isn't going to survive without at least a modest surplus. Even a not-for-profit, the university, your church, the Red Cross, all have to generate at least as much cash as they pay out, otherwise they ain't going to exist. So how do the combined effects of liquidity, asset, and debt, which we just talked about, how do you put those together to ensure that the company is going to be profitable? So there's ratios that analyze that. And then the last one is market value. In finance, we are hand in glove with economics. We love, and if you haven't taken economics yet, fascinating stuff. We're hand in glove with economics because the market tells us, especially when it's a stock market, the big stock market, there's a principle, which we're not going to get into here, which is essentially the efficient market theory, which says if you have all the publicly available information out there, and you've got people who look at these stocks, and you got millions of shareholders, the market price is pretty reflective of what everybody thinks about that company. And in finance, we're not worried about what's happened. We're worried about what the future is going to be. The future. We're worried about the future. And so the stock price is reflective. The bond price is reflective of what the market thinks that stock or bond is going to do, that firm is going to do. So we can look at that and get an idea based upon these ratios and the market values, whether we think that that company has got good prospects for the future or crappy prospects for the future. There's a lot of information out there that we can analyze without having to do a bunch of number crunching ourselves. Because when you're talking about a New York Stock Exchange traded company or a NASDAQ traded company, there's analysts that do all the crunching and they buy the stuff. And if they think it's underpriced, they're buying it. When they buy it, the price goes up because supply and demand. And it reflects the future expectations on that asset. Now, does that hold all the time? No. There's inefficiencies in the market. And that's how people kind of hit home runs. But in general, they're tough to get. And so you take these 5 components, you put them together, kind of all pour them in a pot, stir, And it starts giving you, like I said, this collage, a picture, a big picture of what that firm's prospects look like. Take each one of these little pictures, you put them together, and you paint the story. So now we're going to walk through two liquidity ratios. Here's Unilite again. Current ratio. Current ratio is Skype. Current ratio is really an indication of the company's ability to pay quickly its current liabilities. And so its current assets. What are current assets?
Inventory, buildings.
Not buildings. Not buildings.
Because you can't.
And it can be turned into cash within
Other cash flows.
Yep. So it's your inventory, it's your receivables, it's your cash, it's your cash and cash equivalents, marketable securities, things that you expect to turn into cash within 12 months. What are your current liabilities? Yep. So your bonds that are due within a year, your current portion of long-term debt, your short-term debt, your short-term notes, your payables, salaries payable, all that kind of stuff. So in the case of Unilite, they've got 465 million in current assets, 130 million in liabilities, current liabilities. So it's 3.6 times. Is that good or bad?
Bad.
Why?
Because the industry average is 4.1. They're performing below industry standards.
They're performing below industry standards. Here's something that is critically important when you're using ratios. In many cases, it's difficult to just go 3.6, is that good or bad? I don't know. It might be good in this industry, it might be bad in this industry, 1.0 might be good in some industries. It's important when you're doing financial analysis to have benchmarks. To go, okay, industry average. What's the industry average for textiles? Well, it's 4.1 times. So Unilite is somewhat below industry average. Because some industries have to carry larger inventory. Some industries have faster inventory turnover. Those are other ratios. And so you've got to look at the industry and try and time the stuff up and align it with other industry averages or other companies you're comparing it to. And then generally, higher is better in this ratio case. Because the industry average of 4.1 times says most companies in the industry have a little bit more cushion than Unilite does. So it suggests it's not as liquid. It's probably not critical because it's close, but it's one of those things, kind of stick it up on the wall on a Post-it note. How many of y'all saw Beautiful Mind, the John Nash movie? Okay, there's a precious few of us. When you get into financial analysis, or if you're geeky like me and you like to do financial analysis, I equate it to like It's a Beautiful Mind, where you start putting these things up on the wall, where you start putting them on a piece of paper, you go, okay, this is a little bit lower. I'm gonna set that over here. Don't make a full judgment on Unilite yet, but we've looked at the balance sheet, we've looked at the income statement, we've looked at the statement of cash flows, we've looked at retained earnings, and now we started looking at some of these ratios, and we're like, okay, there's another piece. Again, we're building this collage, this big picture story. So here's the quick ratio. The quick ratio essentially says we're taking inventories out of the equation because we can't turn inventory necessarily that fast, or if we do, we may need to sell it at a big discount. So quick ratio is really cash equivalents, and receivables. 195 million over the current liabilities, which is due within 1 year. So they're at 1.5 times. Industry average is 2.1 times. So tell me a couple things. You can see the kind of the story that we painted down here. Tell me a couple things that take quick ratio, take the current ratio, take the information that we've already looked at, and give me a little bit of a story about how Uniflight's managing cash and inventory.
All of the bonds and all the liabilities they've taken on, not all of it was paid to the investors. So someone mentioned yesterday that this was a building year, and it looks
So you're saying, hey, they borrowed a bunch of stuff. They're building. Probably a little bit less cash. We're going to look at cash. But we saw cash went way down. So if cash went way down and inventories are out, what we're seeing is, it was close when we looked at the current ratio between industry average and their current ratio. Quick ratio is getting further away, which means they're probably, the bulk of it is inventory management, most likely, and went down. Right? Which means they're probably sitting on a bunch of receivables as well. So the receivables might be too high, or it might be higher than industry average, or they're getting paid slower. Well, inventory is overpriced, so they're not turning it, and that's pulled out of here. Yes, sir.
They only increased their receivables by 20 million. So and their went down by 70. So I don't know. Probably see something. Yeah. So their inventory went their spreadsheet, their balance statement.
Inventory went up or down?
It went down.
Inventory went up.
No, what on the balance sheet?
Went up. Are you looking at cash flow statement or balance sheet?
Statement.
If you're looking at the cash flow statement, it'll say 70 million of cash. Basically, cash went down 70 million because it got invested in inventory. The summary, when we're looking at when we're looking at liquidity, we can kind of draw a couple quick conclusions. One is their liquidity is a little bit worse than industry average. As a matter of fact, when we look at the real cash piece, that real current stuff, the quick ratio, it's pretty poor. And it may have problems paying its bills because it doesn't have a lot of cash. It's converted most of its cash into other stuff. So then we've got the asset management ratios. They bought a bunch of things. They bought some equipment, they've got inventory, and they've got other things. So how are they actually turning that into cash? Because at the end of the day, we don't want plant and equipment. We don't want inventory. We don't want receivables. We want cash. We want to turn all those into cash. And if an asset isn't generating cash, we want to sell that asset. Get it off the books, turn it into cash. So we're going to look at 4 ratios for asset management. Inventory turnover, how quickly are they getting rid of their stuff? So they're making it, how quickly are they selling it? Days sales outstanding, how long is your receivable sitting out there? Fixed assets turnover, how efficiently are they utilizing their fixed assets and turning that into cash? And then total asset turnover. Essentially, how are they managing that left side of the balance sheet? What do we have? The picture starts to get a little clearer as we look at this ratio. Cost of goods sold over inventory. So cost of goods sold is basically the amount that is sitting on the books. That we built the stuff, now we're going to sell it. What we built and sold goes into cost of goods sold, the cost of that. What we haven't sold yet is the inventory. So we're assuming that the inventory is pretty normal at 270 million. And we had a cost of goods sold of 1.23, 1,230 million. So 4.6 times. Industry average, 7.4. So we're seeing that inventory is a major problem. It's sucking up cash. It's holding $70 million of additional cash. It's stuck in inventory, and we're not selling it nearly as fast as everybody else. So give me based on what you've seen, I mean, I kind of told you that's what this says. Based on what you've seen, tell me why this might be the case. Why is this selling so much slower than the industry average? Potentially you have inferior products.
Is it priced too high?
Could be priced too high. What else? Not advertised effectively. Don't have the right customers. Yes, sir. They made more than they could sell. So some of this, again, we talk about how all this stuff starts to interact. These are the questions that you'll start writing down, because when you're going to interact with management, or you're going in for your interview, or you're looking at the company from the perspective of an auditor and going, do they have going concern? Do they have going concern issues? You're going to start writing this stuff down, and you're going to start asking those questions. The new equipment they bought, they could only do long run stuff, and it all sells at Christmas. And so they're like, okay, well, this is normal because our product mix is different than the industry average, and we have a rationale for it. But more likely than not, it's a combination of all the hypotheses you guys just came up with, as well as several others. And we're going to start digging into some of that and see whether Unilite's got some problems. Days sales outstanding. This is receivables over daily sales.
So they're receiving them.
So essentially what we're trying to measure is, okay, how quickly are we getting paid in cash? So we're floating credit out to our customers, and then they eventually pay us. What do we want? Cash. We don't want receivables, we want cash. Cold, hard cash. So this, we normally use in finance a 360-day year. Why? I don't know, but that's normally what you're going to find us using. So if you look at Unilite, they've got 180 million in receivables. Their average sales are $4 million a day. So it's 43.2 days worth of receivables sitting out there. The industry average is 32.1 days. They ain't receiving their money. So we got now two problems we've identified with Unilite's asset management. One, they're sitting on a ton of inventory, and they're not turning that inventory nearly as fast as everybody else. And second, even when they do sell it, they ain't getting paid in cash for 10, 12 days longer than everybody else. So their customers may not be able to sell the stuff either, because the customer is then likely reselling this to somebody else, because this is a textile manufacturer, so they're likely selling jackets or something else to somebody else who's then reselling it, which starts creating, in my mind, a story around the product might be screwed up. You've got a product that nobody wants, or a product that is really slow moving. It's slow moving because you're sitting on a ton of inventory, and it's slow moving because your customers, who are in this case probably retailers, aren't able to convert it to cash and then pay you. Or you're making some really lousy decisions in your sales department around extending credit. Fixed asset turnover. What are fixed assets? Buildings, land, equipment, property, plant, equipment. So what we're looking at is sales over net fixed assets. Essentially, how quickly do we do our fixed assets, how efficient are we in turning our fixed assets into cash? Unilite 3.9 times, industry average 4 times. Do you think this is good or bad? It's good-ish. Yeah, Unilite seems to be operating, so it doesn't seem to have too much in the way of fixed assets. Relative to what it's selling, the fixed assets that it's got seem to be fairly well in line with other industry, or with other members of the industry. So you're not seeing, they don't have a ton of stuff that's probably sitting idle. They're able, and they're not overbuilt. They probably don't have a lot of excess. And they're probably not stretched right to the limit, so that they don't have growth opportunities with their current assets. So the last thing we're going to talk about is the total asset turnover, and then we're going to dive into the rest of the ratios next class. Total asset turnover, sales over total assets, all the assets. So they've got 845 million in assets, 1.5 billion in sales, 1.8 times versus 2.1 times. The asset turnover ratio is below the industry average, which suggests it's not using all of its assets as efficiently as other firms. But tell me more. What assets aren't they managing efficiently? Inventory and receivables. Because the property, plant, equipment seems okay. And so when you think about what I have for assets, well, I've got property, plant, and equipment, I've got cash, and I've got receivables and inventory. That's my big buckets. So it comes back to, and again, if any of you guys end up, the management folks in here, you end up in management consulting, and you're going, I'm walking into a company and they're asking me to fix this screwed up mess. This is the type of work you'll end up doing. To go, okay, where's the problem? It probably ain't on a production floor. The problem with Unilite is in two spots, and probably predominantly one. We're looking at inventory and accounts receivable are kind of screwy, and that's probably being driven by products that aren't really what the market wants, which is delaying their ability to sell that inventory and their ability to get paid. So if you're in marketing and you see this, you're going, I got a product problem. If you're in management and you're looking at where is my company screwed up and where do I need to put my resources, it's likely a product problem or a receivables management problem or inventory problem. And with that, I will see you all on Friday.